Okay, so let's continue with question 5. We are still on IAS 8, accounting policies, changes in accounting estimates and errors. We are solving questions, right? So in the previous video, we solved one question on IAS 8, right? So in this video, we're going to continue and solve questions. So let's start with question 5. Question 5, right? So question 5 says, during 2018, a company discovered that certain items had been included in inventory at 31st December 2017 at the value of 2.5 million, but they had in fact been sold before the year end. The original figures reported for the year ending 2017 and 2018 are given below. So we have 2017 and 2018. So we have sales, cost of sales, gross profit, we have tax, and then we have net profit, right? And it says the retained earnings on 1st June 2017 were 11.2 million Ghana cedis. Assume the adjustment will have no tax effect. And then it says A, in accordance with IAS 8, how will this event be classified? And B, show the income statement and the comparatives and the retained earnings for each year, right? So this question is on error. It's on error. What is the error in the question? The error is with closing inventory in 2017, right? Closing inventory has been overestimated by 2.5 million, right? We're told that here, it's here at the value of this. It says they have included inventory, okay, at a value of 2.5 million in the closing inventory of 20 what 17, right? It says certain items had been included in inventory at a value of what 2.5 million, but in fact they have been sold before the year end. So the error is that they have overestimated what closing inventory. They've sold it, but they have included it. They've included the value in the closing figure, right? So the error is that they have overestimated closing inventory. The error is with overestimation of what closing inventory. And we said when closing inventory is overestimated, what is the impact? So when we overestimate closing inventory, we are reducing cost of sales. And when cost of sales is reduced, profit increases. Are you getting it? When we overestimate closing inventory, we are deducting a bigger figure from closing inventory, and so that will reduce cost of sales. And when cost of sales reduces, profit is overestimated because we have to deduct the cost of sales from what revenue to get profit. So when we overestimate our closing inventory, we are reducing cost of sales, and when cost of sales is reduced, profit increases. So when we are correcting the error from cost of sales, we have to add it back to cost of sales, right? Because we said the error will reduce cost of sales. So when we are correcting the error from cost of sales, you have to add it back to cost of sales. When you are correcting the error from profit or using profit, then we have to less it from profit, right? So when we are correcting the error from cost of sales, we have to add it to cost of sales because it will reduce cost of sales. And we are correcting the error from profit, we less it from profit because it will overestimate or it will what increase, or the error has increased our profit. So when we are correcting it from profit, we have to less it from what profit. That's all. So let's do the adjustment. Let's start with 2017. Okay, so with 2017, okay, so here to the same, we have two methods. We can do it two ways, right? So we can do it, let's say method one. And method one, we will adjust cost of sales. Okay, so with method one, we will adjust cost of sales. So let's pick our cost of sales and adjust the cost of sales. And then method two will adjust the profit straightforward. So let's say per trial balance or per question. Okay, so the cost of sales per question in 2017, okay, cost of sales per question is here 30,200. So we'll bring it here 30,000 what 200. Then we said this error will reduce cost of sales. They have deducted a bigger figure from cost of sales in 2017. So they have reduced cost of sales. We have to add back. Okay. So we add the error. How much is the error? The error is 2.5 million, which is 2 million 5 2,500,000, which is 2,500, right? Because we are working it with three zeros. Okay, don't forget we are working with three zeros because we have three zeros up there given to us in the question. Okay, so we are working with three zeros. All our workings are in three zeros. Okay, so when you add this one to this one, what do you get as the corrected or the adjusted cost of sales, right? So we are going to get the adjusted cost of sales. So we have adjusted cost of sales as 32,700. 32,000 what? 700. So 32,700 is the adjusted cost of sales. So we can now go back to the P&L and then use it. I following. So we have um our adjusted profit now or revised P&L. So our revised profit or loss. Okay. Our revised profit or loss now. Let's revise everything. So sales, we have sales in the question. Sales has not been affected. There's no error affecting sales. So we leave the sales. 2017 is 48,300. So you bring it here. 48,300. 48,300. Then we have the cost of sales. The cost of sales is what we just adjusted. So we are going to use the revised cost of sales, which is 32,700 that we computed. Okay. So we are just going to use the adjusted cost of sales instead of the old one. I mean, instead of the one containing the error, we are going to use the revised cost of what sales. So instead of using the 30,200, we've revised it and it's down 32,700. So that's what we are going to use. So we deduct the cost of sales from our sales or revenue, and then we have 15,600. 15,600. Okay, so that will be our gross profit now. So we have gross profit to be 15,600. 15,600. Okay, then we have the tax. Okay, so let's less our tax. And the question said we shall assume that the adjustment will have no tax effect. When you come here, it says there will be no tax impact. So tax remains the same. I following. Normally the tax is computed on the profit, a percentage of the profit, right? But they said the error will have no impact on tax, meaning that it will be the same. It will be the same tax figure that we are going to use. The same tax figure that we are going to use. The tax figure will not change. Okay, so we have 4,300. You underline, and then we get the profit after tax of what? So our net profit of 11,300, right? So this is the corrected or the adjusted net profit in 2017. Okay, with method 2, here method 1 we adjusted cost of sales. Okay, with method 2 we will just pick profit and adjust the profit straightforward. Okay, we are not going to adjust cost of sales, but we just pick profit and we adjust it straightforward. Okay, so with method 2, let's bring the profit containing the error. Okay, So with the profit that has the error, the profit that has the error, this figure here, this one here has the error. So we just bring that figure down. So the profit is 13,800, 13,800, right? So that's the profit. Then let's go and adjust the error. Now we said the error in 2017, the error is that we have overestimated closing inventory, right? We've overestimated our closing inventory. Instead of eliminating the 2.5 million, instead of eliminating the 2.5 million goods that were sold, we included it in inventory. So we have overestimated closing inventory. And when we overestimate closing inventory, we say cost of sales reduces and profit increases. So the impact is that profit has increased. So to correct the error, we have to less it. Okay, so we'll less the error. How much is the error? It's 2,500,000. So when you less the error, okay, then this should give us the same answer, 11,300. So we have to get 11,300 as our adjusted net profit. Okay, it is 11,300. Okay, so that's all. You can adjust the error in cost of sales, or you can adjust the error with your net profit. Whichever way you do it, it's fine. It's fine. So just know how to go about the two. Okay. So with the second method, we just pick the net profit and we adjust the net profit. But with the second method, we had to go and pick, and with the first method, you have to adjust the cost of sales first before you use it to do your computation. Let's look at 2018. So this 2017, 2018 will follow the same or similar format, right? So 2018 will follow the same thing. If not the same, it will be similar. So 2018, okay. So 2018, and with 2018, let's start with method one. Okay, let's do our method one. Let's do method one. So method one, as we said, the same format. We pick cost of sales and we adjust the cost of sales first. Okay. Then when we are done, we use the method two. Okay. So method one, let's bring our cost of sales. Okay, so per question, what's the cost of sales per question? So per question is, we are back to 2018 now. We said 2018, the closing inventory of 2017 becomes what? The opening for 2018. And we said that when closing inventory has an error, it affects the opening inventory. So 2017, we overestimated our closing inventory by 2.5 million. 2018 to the opening balance of 2018 will also be affected. So the opening balance of what? Inventory in 2018 will also be what? Affected by what? The error. So 2018, we have overestimation of opening inventory. And when opening inventory is overstated, okay, when opening inventory is overstated, cost of sales increases and profit what? Reduces. So if you want to adjust the error from cost of sales, because we said the error will increase cost of sales or will lead to overstatement of cost of sales, since we said the error will increase cost of sales or will lead to overestimation of cost of sales, we have to less it from what? Cost of sales. And then we said the error after increasing cost of sales, profit will what? Reduce. So if you want to adjust the error from profit, we have to what? Add it to profit. Are you following? If you want to um if you want to adjust the error from from the profit side, okay, then we have to add it to profit because we said the error will reduce profit. But from the cost of sales, since it will increase cost of sales or it will lead to overstatement of cost of sales, we have to less it from cost of what? Sales. So the 2018 cost of sales per question is here 33,500. So it's 33,500. Then we will less the overstatement of opening inventory. So we less the error. So we less the error. And then the error is 2,500,000. Okay, and then this will give us the adjusted cost of sales. Adjusted cost of sales. So we have adjusted cost of sales. Now, sorry, so we said the error is 2,500. We less the error, and then this will give us 31,000, right? So we have the adjusted cost of sales. Adjusted cost of sales is 31,000. Then we now just come and put it into the P&L account. So our revised profit or loss sales 2018 is 52,100. Then we bring the adjusted cost of sales. Okay, so our adjusted cost of sales is 31,000. Then we less it 31,000. And then we have a gross profit of, so we underline, and then we have a gross profit of 21,100. 21,100. So these are gross profit. Okay, 21,100. Then we less the tax, still saying that tax will not be affected. So we use the same tax. And in 2018, the tax is 4,600. When we less it, we have net profit of 16,500. 16,500. So this is our net profits after deducting the tax, right? Okay, or let's try the method 2. If you want to use method 2, then we said we just bring our net profit and then we adjust the error. Okay, so method 2, let's bring the profit after the error has been committed, which is 14,000. So we bring the 14,000. Then we add the error, and you know what we are adding? We said we are adding the error because the error has reduced profit. The error has increased cost of sales, right? And when cost of sales is increased, profit reduces. So you have to add it back to the profit. Okay, and then when we do this, this will give us the same answer, 16,500. So it depends on how you do it, whether you want to adjust the cost of sales first before you use the figures, or you want to go and pick the profit and adjust the profit, right? So either you adjust cost of sales right? That's the profit. So this is it. You get the same thing. Then let's do the retained earnings comparative, and then we come and answer the A. A says how would the event be classified? So let's do the retained earnings. Okay, so retained earnings, it's very simple. So we have to do our retained earnings adjustment. Okay, so let me use RE to be retained earnings. My control V here. We are working in thousands. Okay, so retained earnings. Let me bring 2018 and then 2017 here. You can bring 2017 first, depending on whichever you want to work with it. So within any, we bring the opening, right? So we bring the opening retained earnings. 2017 opening retained earnings is given the question right here, 11.2 million, and this error is not affected by the this balance is not affected by the error, right? The 11.2 million is not affected by the error. So 2017 we have opening balance of 11.2 million, right? So this is the opening balance for 2017. Then we will add profit for 2017. So we add a profit. How much is the profit for 2017? Just flip back. 2017 profit, adjusted profit was 11,300, 11,300, right? So it was 11,300. That is the profit for adjusted profit for 2017. Okay, so when you add this, we should get 22,500. So let's underline. So we'll get the closing retained earnings. We'll get closing of 22,500. So 22,500. And then we know that the closing of one year becomes what? The opening of the other year. Okay. So if 2017 closing is 22,500, then when we go to 2018, that will become the opening. So 22 what? 500, right? Then we add profit for 2018. Profit for 2018 is 16,500. What we just computed. You can just go back and check 16,500. So we add profit for 2018. Profit for 2018, which is 16,500, right? So you just know that the closing inventory of 27, the closing retained earnings of 2017 becomes the opening retained earnings for 2018. That's all. Okay. So when you are done with 2017, you bring the figure down. So that's it. So opening for 2017 was 11,200. Then we added this profit for 20 what? Net profit for 2017, 11,300, and we got 22,500. And then we brought it here because the closing for 2017 becomes the opening for 2018. So we brought 22,500 as the opening for 2018. Then we added profit for 2018, 16,500, and you're going to have 39,000 as our 39,000 as the closing retained earnings for 2018, right? So that's it. Very, very simple. Okay, so let's get question 9. Also on error. Okay. Question 9. Let me zoom it down small. Okay, so I think you can see the whole question now. The full question. Okay, we have it here. Okay, so let's look at question 9. Question 9. Okay, so question 9 says Kano Transport Company is preparing its financial statement for 2024. The draft statement of changes in equity is as follows. So we have share capital, retained earnings, stated reserve, and then total. So we have balance as at 1st December 2022, balance at 1st December 2023, then we have 2024 dividend, profit for the year, and then the closing balance. And we are told that KTC has now discovered an error in its inventory valuation. Inventory was overstated by 70,000 at 31st December 2024 and by 60,000 at 31st December 2023. The rate of tax on profits was 30% in both 2023 and 2024, and the requirement is we have to redraft the statement of changes in equity. So this is very simple. We had 2 years, right? So let's start. We had in 2023, okay, in 2023, inventory was overstated by 60,000, and 2024 it was overstated by 70,000, right? So let's pick year by year and do the adjustment. So let's start with 2023. Okay, let's start with 2023, and all the workings are in thousands, 30s. As you can see, it's up there, right? The workings are 30. So we have to redraft the profit, and here we have only profit. It's only profit that we are going to use. We don't have the sales, the cost of sales and stuff. We are going to only redraft the profit. We just have to pick profit for 2023. Okay, now 2023 was the profit. If you scan through the statement of change in equity, okay, here we have balance. Here, if you come here, we have balance as at the 3rd December 2020. What 2. So this is the retained earnings balance, 90,000. Profit for the year, this 150, and they got balance as at 2020 what 3. So you would realize that this profit for the year, this 150 profit for the year, is the profit for 2020 what 3. Are you getting it? This is statement of changes in equity, or let me say this is the changes in equity given to us, right? And look at it. We said this 2022 year, it's the opening balance. So if we go to 2023, the closing for 2022, okay, is the opening for 2023. So this 90,000 here is the opening balance or the opening retained earnings for 2023, and then they added profit for 2023, and they got the closing balance for 2023. So that's it. Okay, so for 2023, the profit that we are going to use is we are going to use 150,000. 150,000. That is the opening, and that's the profit for 2020 what 3. Okay, so we have 150,000 as profit for 2020 what 3, before the correction of what the error, profit 150,000. Then we were told that they have overestimated inventory by 60,000 in 2020 what 3. They have overestimated inventory by what 60,000. They've overestimated inventory by 60,000. Now, what's the analysis? If inventory is overstated, okay, if inventory is overstated, if inventory is overstated, the closing inventory, what happens? If closing inventory is overstated, cost of sales reduces. Cost of sales what? Reduces. Are you following? And then profit will do what? Will increase. If you overestimate your closing inventory, you are going to deduct bigger figure, and so cost of sales will reduce. And when cost of sales reduces, profit increases. So when we are doing the adjustment from profit, we have to what? Do what? We have to less it from what? The profit. Because we said when cost of sales, when we overestimate our closing inventory, we are deducting a smaller figure. I'm sorry, when we overestimate our closing inventory, we are deducting a bigger figure. And then cost of sales will what? Reduce. And when cost of sales reduces, profit increases. So if you want to correct the error from profit, you have to less the error from what? Profit, right? Because we said when closing inventory increases. When we deduct a bigger figure, when we overestimate our closing inventory, cost of sales reduces and profit increases. So if you want to correct the error from profit, we have to less it from profit. So we will less the error. How much is the error? The error is 60,000 in 2023. So you less of 60,000. Then the tax, here there's tax. You have a tax of 30%. So we said when you less the error, you add the tax. If we should add the error here, if we should add the error, would have deducted the tax. But here we are lessening the error, so you have to add the tax. I tried to explain. I explained this one in the first video why we do it this way. Whenever we less the error, we have to add the tax. Whenever we add the error, we have to less the tax. And whenever we less the error, we have to what? Whenever we less the error, we have to add the tax. And whenever we add the error, we have to less tax. So it's the other way around, the opposite. Okay. The tax is 30%. So yes, find 30% of this one. So 30% of the 60, right, will give us 18. So we have to add 18. So we less the error, 60, we add 18, and that becomes our adjusted profit in 2023, right? So we have 108 as the adjusted profit, 108. Then let's go to 2024. 2024. Now with 2024, we said the closing error, the closing inventory in 2023 becomes the opening in 2024. So in 2024, we have two errors: opening inventory and closing inventory, because we said the closing for 2023 becomes the opening for 2024, right? So with the error in 2023, the 60,000, we have overestimated the opening what? Inventory. We have overestimated the opening inventory, right, by 60,000. And then the closing too, we've overestimated it by 60,000. Are you following? So how do we do it? Let's bring the net profit. So what will be our net profit? Our net profit is for 2024. Let's come here. So we have 2024 dividends, profit for the year. So profit for the year is what? We have 385. So we have 385 as the profit for 2024, 385. Then we are going to have the error. So the errors, as I said here, the errors are two. We have error with the opening. Okay. So with the opening error 2024, if you overestimate your opening inventory by 60,000, you are overestimating cost of sales also by what? 60,000. And when cost of sales is overestimated, profit what? Reduces. So we have to add the opening error. So we have to add the 60,000. Okay, so with the opening inventory error, we have to add the opening. Are you following? Okay, so let's add the opening 60,000. And then the tax element on it. What will be the tax element? We said we are adding the error, so we have to less the tax, right? So what will be the tax on the opening? So the tax will be 30% of the 60. Okay, 30% of the 60. So 30% of the 60. So 30% of 60, and that will give us 18. So 18, and then the 18 will be what? Less. Okay, so we less the tax element because we are adding the error. Then let's go and work on the closing. In 2024, closing was overestimated by 70,000. So when we overestimate closing inventory, when we overestimate our closing inventory, we are reducing cost of sales. And when cost of sales reduces, profit what? Increases. So with the closing inventory 70,000, we have to less it. So we less the closing. Okay, the closing. How much is it? So here we are doing the adjustment from we are doing the adjustment here from profit, right? So less the closing. How much is the closing? It is 70,000. So we less 70,000, and then we'll add now because we are lessing the error, we have to add the tax. So what's the tax? The tax will be 30% on the 30% on the 70,000. So 30% by 70, 30% by 70,000, and that will give us 30% by 70. That will give us 21. So you have to add a 21. Okay. Somebody can find the net. We are adding opening 60. We are adding opening 60 and we are letting closing 70. So somebody can just find the net. It's the same thing. Okay. So we have a figure of the adjusted profit. So we have our adjusted profit to be 378. 378 as the adjusted profit. 378. Okay, somebody can do this way. We'll pick the profit. We'll add, say we are adding 60,000 and we are lessing 70. Okay, so the difference is 10, meaning we'll be lessing 10. So we can do it this way. We are adding 60, we are lessing 70. So the net is of 10, we are lessing 10. So pick 30% of the 10. Okay, 30% of the 10, and that will give us 3. So you add the 3, it's the same thing. Okay. So instead of doing them separately, you can just find the net, the 10, that we are adding 60, we are lessing 70. So 10, we are lessing 10. So if you are lessing 10, you add back the tax on the 10, which is 3. So it's the same thing. Okay, so we have in the opening here, then we less the 10 and we add 3, you get the same answer. Right. So just get the concept. But I did it separately. So that's it. And then say we should redraft the statement of change in equity. So change the equity, if you come with the same thing, okay. The only thing that will change is that if you come to 2023, okay, if you come to the question here, 2023, we have a figure of 150 as um the profit 2023 here. So when you come here, 2023 here, they had what 150. So this is profit for 2023, 150. You don't use the 150, okay, but you have to use what 108. That's the adjusted profit we got, 108. So use 108 here. So the only changes you do is you replace this 150 with 108. Replace this 150 with 108. That's all. Then when you come to 2024, dividend not affected. When you come to 2024 here, profit here, this 385. Okay, replace this 385 with the figure we got. We got 378 as the adjusted profit for 2024. 378. So use 378 there. That's all. So just copy the same thing, copy this whole thing here, but do changes to only the two. That's all, right? And then you get your closing retained earnings. Okay, so the only thing we are going to do here is diagram with the retained earnings column with the share capital, reserve, everything, maintain it. The only thing is the profit. So 150 here, you replace it, and then 385 to replace it, and then do the additions, and that will be your revised statement of changes in what equity, right? And the opening balance becomes the closing of the other. So if you come to 2023 here, okay, when you get the closing balance for 2023, that becomes the opening for 2024. Okay. So here it will be 90 plus, it will be 90 here, this 90 plus 108. Then you get a closing figure here. Then the closing figure, you less the dividend, and then you come and add 378 here, and that will be it. Okay, so we draft it, and then that's all. So we've corrected the errors. Okay, so that's it. That's not all. These ones are on errors. In the next video, we'll be solving questions on changes in estimates. Okay, and then we'll also solve another question on um, changes in policies. So we are left with changes in policies and then changes in estimates. This one that we solved are what? Errors. So we have changes in estimates and changes in policies, right? So I'll see you in the next video.